Most financial content gives you vague platitudes or extreme predictions. Today, we're doing something different. The second pillar is the monetization of its existing user base. The password sharing crackdown wasn't just a one-time boost, it's a permanent uplift in average revenue per account. The ad-supported tier is a runaway success, creating a new, high-margin revenue stream that is still in its early innings. Netflix's global production engine and data-driven approach to greenlighting projects give it an efficiency edge competitors struggle to match. Their forays into gaming and live events are strategic hedges that deepen engagement. The bull thesis is clear: you're buying a profitable, cash-generating leader with a durable competitive moat. And smart growth avenues, trading at a premium that its execution may continue to justify. Now, we must turn with equal rigor to the bear case. Ignoring these risks is how investors get hurt. The primary concern for any investor looking at Netflix today is valuation. After its massive run-up, Netflix's stock price reflects near-perfect execution. Its price-to-earnings ratio is significantly higher than many traditional media companies and even some tech peers. When you pay a premium price, you demand premium performance. Any stumble, a quarter of lighter-than-expected subscriber ads, a slowdown in ad-tier adoption, or a few expensive content misses could lead to a sharp downward re-rating of the stock. The second major risk is the intensity of competition. The streaming landscape is a war of attrition. Disney+, Amazon Prime Video, Max, and Apple TV Plus are all backed by deep-pocketed parents willing to lose money for years to gain market share. This perpetual content arms race puts relentless pressure on Netflix's spending, potentially capping its future profit margins. The third risk is saturation and growth deceleration. Netflix is already in most households in its core markets like North America. Future subscriber growth will increasingly come from harder-to-penetrate or lower-revenue regions. The explosive growth rates of the past decade are mathematically impossible to sustain. Bears argue that the current stock price fails to adequately discount this inevitable slowdown, treating Netflix as a high-growth tech company when it's maturing into a slower-growth media utility. So, with these two powerful narratives clashing, how does a rational investor decide? The answer depends entirely on your personal investment profile and time frame. This is the most crucial part of the discussion. You need to diagnose what type of investor you are. Are you a long-term growth investor? If so, you might believe Netflix's initiatives in gaming, advertising, and live events will open new multi-year growth cycles, and you're willing to hold through volatility to capture that. Are you a value or income investor? Then the massive free cash flow and potential for future dividends might be appealing, but you'd likely want to wait for a better entry price during a market pullback, as the current valuation might not meet your strict criteria. Or are you a momentum or tactical trader? Then you're less concerned with 5-year projections and more focused on the current trend and sentiment, which, while strong, could reverse quickly on bad news. There is no universal good buy. A stock can be a perfect buy for one strategy and a terrible buy for another. You must also assess your risk tolerance. Netflix, as a leading but single company in a volatile sector, is inherently riskier than a broad market index fund. Are you prepared for the possibility of a 20 to 30% drawdown if the market sours on growth stocks again? Your honest answer to that question is more important than any analyst's price target. Let's add a layer of professional nuance with some key metrics and questions to research yourself. Don't just take anyone's word for it. First, look at the price-to-earnings growth PEG ratio. It compares the P/E ratio to the company's expected earnings growth rate. A PEG around 1 can suggest fair value. Much higher can signal overvaluation. Second, monitor free cash flow margin. Is it continuing to expand, or is it plateauing? This tells you if the profitability story is intact. Third, watch the engagement metrics, not just subscriber counts. Are users watching more hours per week? Is churn cancellation rate staying low? This indicates the health of the content slate. Finally, ask the strategic questions. Can Netflix successfully raise prices again without pushback? Is the ad tier actually stealing users from the more expensive plans, or is it purely additive? We must conclude with a critical and non-negotiable disclaimer. This video is strictly for educational and informational purposes. The bull case is built on stellar execution, financial maturity, and smart new revenue streams. The bear case warns of premium valuation, fierce competition, and the law of large numbers on growth. Your job is to weigh these factors against your goals, timeframe, and risk tolerance. If you believe Netflix can continue to defy saturation through innovation and monetization, and you're prepared for a volatile hold, it might be a candidate for a portion of your growth allocation. If you seek deep value or minimal risk, you might look elsewhere or wait for a wider margin of safety. I hope this framework empowers you to think like a principled investor. If you found this balanced approach valuable, please support the channel with a like and subscribe for more objective financial breakdowns. Now, I'd love to hear your take. Based on your strategy, are you a buyer, a seller, or watcher on Netflix at these levels? Let's have a thoughtful discussion in the comments below. Thanks for watching, and invest wisely.